How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today there was this week, there was a fascinating report that came out from the Federal Reserve Bank of New York. And this report was really explosive in a lot of ways. What it found was that 22 banks saw deposit runs amid the March 2023, they call it the liquidity crisis. You could just call it a crisis, banking crisis. So first, I want to bring a article in here from S&P Capital Market Intelligence. And like I said, just 22 banks saw deposit runs amidst March 2023 liquidity crunch. And then I'm going to actually show you the report for a second, and we're going to kind of walk through this. So let's just take a look at what we have here. So 22 banks experienced a run on their deposits in March of 2023. Researchers at the Federal Reserve Bank of New York found in a new report based on an analysis of confidential high-frequency interbank payments data. The Fed researchers found that 22 banks experienced deposit outflows over 5 standard deviations of their historical net outflow rates between March 9th and March 14th, 2023. The runs were largely concentrated on March 10th and March 13th, with some of the banks losing as much as 10% of their assets in a single day. The analysis also found that large depositors, as opposed to retail depositors, were the driving force behind the runs, that the banks tapped wholesale borrowings and recovered outflows by raising deposit rates to survive. Over 10 times more banks faced a run during this period than failed, the researchers wrote. On the other hand, runs were less widespread than suggested by the decline in bank stock prices. And then it goes on to say, this evidence is consistent with the Federal Home Loan Banks acting as a lender of next to last resort, where banks in urgent need of liquidity follow a pecking order, preferring to first borrow from the Federal Home Loan Bank, and only when this has become impossible, they tap the discount window. So, and then it goes on to say, among the discount window and the BTFP, which was a kind of like an emergency lending program that the Fed had created, the run banks preferred the discount window, with 93% of emergency Fed borrowings at March 15th coming from the discount window, even though the BTFP valued securities at par. Well, my guess is that they were probably already set up with borrowing from the Federal Reserve discount window, and that's why they decided to go with that as opposed to the BTFP, which was literally just announced and was just being rolled out at that particular moment. So that would kind of explain that. Now, obviously, we saw much more increased borrowings on the BTFP over the following months as we kind of went along, and people, banks got a little bit more comfortable with that lending facility. Now let's go see here. So runs on March 10th were highly concentrated in the hours after the FDIC announced the failure of Silicon Valley Bank, but the agency's March 13th announcement that it would protect all deposits at Silicon Valley and Signature Bank was not enough to prevent large depositors from fleeing these institutions, as 19 bank runs occurred March 13th. Depositors largely fled to banks with more than $250 billion in assets. Although balance sheet characteristics that were fundamental risks for Silicon Valley Bank, such as lower cash holdings, lower capital ratios, higher uninsured deposits, and higher unrealized losses on held-to-maturity securities, did make banks more likely to experience a run, many banks that exhibited these traits did not, indicating that balance sheet fundamentals are not the sole driver of runs, the researchers wrote. Instead, publicly traded banks were more likely to experience a run during that time. Indeed, on the run days, and on those days only, we find a significant relationship between bank stock returns and liquidity outflows, the report read. Publicly traded stock is a highly significant predictor of runs. Even so, 4 of the banks that experienced a run are not publicly traded, they added. So, and of the 30 banks with cumulative stock returns worse than negative 20%, only 9 suffered a run, the researchers wrote. This suggests that we should be cautious when using stock returns as a proxy for depositor behavior. So, and there's a little bit more to this. I'm going to show this to you when we show the report here in just a second, but I just want to go back for a second here. So it talks about, it gets into kind of statistical calculations here at the very beginning when it talks about the banks experience deposit outflows over 5 standard deviations of their historical net outflow rates. So that's that, meaning that is very high. If you're typically, you're within 1 or 2 standard deviations. If you're 4, 5, 6 plus standard deviations out there, that's pretty significant. Just to give you a little context there with that. But what I found interesting here is that they said the analysis found that large depositors, as opposed to retail depositors, were the driving force behind the runs. In other words, this was big money. This was large, and this was investment funds, hedge funds, private equity firms, other big players on Wall Street, big, probably family-owned type, what do they call it, family offices, with probably large deposits sitting there. So that it was the large depositors that were moving this, as opposed to the mom and pop, just retail depositors. Hey, I've got $20,000 in the bank. So that's a very interesting thing to note here. Behind the runs that the banks, and then basically the banks tapped the Federal Home Loan Bank line of credit. But then they also recovered outflows by raising deposit rates, which is interesting here. And then in the report, it actually says that it was more important for banks to raise deposit rates than actually sell securities to basically increase their liquidity position. So again, which is a very interesting facts here. If you go back, I had this whole theory, and I'm gonna switch out here for a second while I'm saying this. So I kind of had this theory, and if you guys go back to the crypto series that I did, where I basically talked about the crypto collapse of 2022 and how that led directly to the banking crisis of 2023, and basically how the 3 of the banks that went down were the main crypto banks, and how they, all those crypto funds flew out. And again, it adds a lot of credence here to the large depositors, as opposed to the retail depositors. In other words, the large depositors being those crypto firms like FTX and Binance and Coinbase. They siphoned a huge amount of deposits out of these banks, which I think ultimately caused it's kind of the match that lit the fire. And then, of course, you had all these other problems with, high uninsured deposits, unrealized losses rather, on their bond portfolio. So you had these other issues kind of going on under the hood, so to speak. But hang on a second. Let me, I want to kick that out for a second. And I want to share the actual report with everybody. All right, so let's bring this in. Okay, so this is the report called "Tracing Bank Runs in Real Time," and it was written by Marco Cipriani, Thomas Eisenbach, and Anna Kovner, and this was done for the Federal Reserve Bank of New York. Now, I just want to read the abstract to you here. So it says, basically, we use high-frequency interbank payments data to trace deposit flows in March of 2023 and identify 22 banks that suffered a run, significantly more than the 2 that failed, but fewer than the number that experienced large negative stock returns. The runs were driven by large institutional depositors rather than many small retail depositors. While the runs were related to weak fundamentals, we find evidence for the importance of coordination, because bank runs were disproportionately publicly traded, and many banks with similarly bad fundamentals did not suffer a run. Banks that survived a run did so by borrowing new funds and then raising deposit rates, not by selling liquid securities. So it's again some very interesting points here. And then if we just go down here to the introduction for a second, and then I'm going to run down to the conclusion here. So fragilities inherent in banks' maturity mismatch have led to bank runs for centuries. Despite this, we still have a limited understanding of how runs actually unfold. This paper offers novel insights on modern bank runs using confidential data on wholesale and retail payments, available intraday at the transaction level for the whole cross-section of U.S. banks, to detail the bank runs of March 2023. The use of payments data adds to the empirical literature on recent bank runs, which is either focused only on banks that ended up failing because of a run, has inferred runs in the cross section of publicly traded banks from the behavior of their stock prices, or has relied on lower frequency historical data. Depositors withdraw funds in meaningful amounts must ultimately send that money to another bank. We therefore use confidential Fedwire funds and automated clearinghouse ACH data to interbank payment systems operated by the Federal Reserve to identify banks that experienced unusually large net outflows in March of 2023. And then it goes on here to say, runs are driven by large institutional depositors rather than by many small retail depositors, as we document that dollar payments value from run banks increased much more than the number of payments consistent with high value transfers from large depositors. Indeed, we see almost no evidence of contagion to retail depositors. Looking at ACH net outflows as a proxy for retail withdrawals, the run days are not meaningfully different from other days. We cannot rule out that slower retail-driven runs would have eventually occurred at other banks had it not been for the announcement on Sunday, March 12th, of the systemic risk exception to guarantee all deposits at FVP and Signature Bank. So again, this is very fascinating. So they basically said that they found like almost no evidence of contagion to retail depositors, yet they can't rule out that wouldn't have eventually have played out. But that's not what they saw. This was big institutional money that just sucked this money out of these banks. And then basically, and now I just want to run down here to the final conclusion, which is short. It's short. I promise I won't keep you painful here. Here we go. Okay. So while we have had hundreds of years of bank runs, understanding the causes remains elusive. The novel perspective of intraday payments data sheds new light on these old questions by exploring the patterns of bank runs and banks' responses to being run in March of 2023. The evidence suggests that we can neither rule out sunspot runs nor be confident that informed depositors run only on weak banks. In 2023, we saw evidence of the importance of shared public signals in terms of stock prices, as well as banks with weak fundamentals that saw few net payment outflows. Institutional depositors clearly acted the most quickly, and even official sector intervention may not fully stem their withdrawals. The implications of these results for future deposit runs leave space for additional research. What makes public companies more vulnerable to runs? Is it the common signal and the stock price movements, associated news coverage, or the readier availability of SEC filings relative to bank regulatory data? These results are not consistent with informed retail depositor monitoring of bank fundamentals. Is there any scale of shock that would include widespread retail depositor runs? We leave these questions for future work. So again, very fascinating study here on these banks. And so there's a couple things here. First of all, there were a lot more banks that were in trouble here than was originally indicated. I mean at the onset of this, it was basically a couple of banks that we were looking at that we thought were in real trouble. But now we come to find out, based on this report, that there were 22 other banks that were in serious trouble at this point. And basically, and obviously, you could see why the Fed opened up the the BLTF, if I'm saying that right there. Let me see here. The BTFP, the Bank Term Funding Program. And you could see why the Federal Reserve rushed to get that lending facility out there to banks, so that basically these banks could make sure they had the money that they need. But again, I think the two big takeaways here from this were not so. I mean, again, of course, banks are going to tap their lines of credits in moments of crisis when they have liquidity risk and they need some cash on hand real quick to make sure that obviously depositors can get their money and that the bank can continue operating as normal. So that's all normal. That's all fine and good. What I think is interesting here is that it was the institutional money that we saw flying out the door here, whereas opposed to, I think, some of the things that were said or were researched the retail depositors. It was retail depositors and the internet and being able to transfer money real quick and all the news on social media and everything, and how that moved lightning fast. Well, it turns out, based on this report, that's not necessarily the case. It was the institutional investors who moved lightning fast and transferred their money out at lightning speed to other banks, and got their money basically out of Dodge before the proverbial crap hit the fan, so to speak. And then at the same time, yes, the banks, to kind of secure themselves or to ensure their survival, shore up their position, their liquidity positions, as it were, banks tapped Federal Home Loan Bank. They tapped the Federal Reserve discount window. They tapped the BTFP a little bit at first, and then more in the months after. But the interesting thing here is that they raised interest rates for deposits. Like they raised the CD rates and they raised the savings rates, and that was what enabled them to kind of shore up their deposit base, and to, as well as to get an inflow of deposits very quickly. And they did that as opposed to selling securities to raise liquidity. So again, just some really interesting things that came out of this study. I was really, like I said, I was really kind of blown away when I saw this study earlier this week, and I was reading about this. And I like I said, I just thought that people would find this very interesting. It adds a lot more great information and context to that banking crisis that did occur last year in March of 2023, and gives us some new things to think about as potential. And again, of course, there will be more bank failures. There will be more crisis in the future. Who's to say when or where that happens or how much? I mean, we don't know. But I could tell you as confidently as the sun will come up tomorrow, there will be another bank failure at some point. So the question is, do any of these things that happened here, have ultimately end up having any bearing on that? So again, we'll have to see what happens. So, but if you so I'll wrap up real quick with, if you like this episode, please make sure to like, share, and subscribe. Please make sure to check us out on YouTube, Rumble, and all major podcast platforms. I hope everyone is having a wonderful Memorial Day weekend. Please keep an eye out for other episodes from me this weekend, and I will be back to talk to everybody again real soon. Thanks a lot.